Bitcoin's 4-year cycles are over. In this video, we are going to dive deep into all of the data that supports this thesis and shows why Bitcoin's 4-year cycles are now a thing of the past. And if you stay tuned to the end of the video, I will show you Blockware's proprietary Bitcoin price model. This model shows us that Bitcoin's current price of roughly $115,000 may not be the case for much longer. If capital inflows continue to compound at the same rate they have over the past year and a half, Bitcoin could easily hit a price of two, three, four, or $500,000 by 2030. Before we get into the video, make sure to smash the like button, subscribe to the channel, and leave a comment down below. If you think the 4-year cycle is going to continue, then leave a comment letting me know why. Without further ado, let's get into the video. All right, so all of the charts I'm about to show you come from Blockware's latest report called Bitcoin Matures, the end of 4-year cycles. This report provides an even more detailed breakdown of everything I'm about to show you. So if you're interested in this topic, I highly recommend clicking the link in the description and giving the report a read. So the report is broken down into 5 sections. The first takes a look at the differences in Bitcoin price action, volatility, and profit taking before and after the ETF. The first chart here shows the Bitcoin price in black. In green, we have the year-over-year percent change in the Bitcoin price, and in red, we have the percent drawdown from all-time highs. What you'll notice on the left side of this chart before the creation of the ETFs is Bitcoin had these massive boom and bust hype cycles. The Bitcoin price was highly reactive to new waves of demand, halvings, and other exogenous supply-demand shocks. Bitcoin would have exponential parabolic moves, as noted by the green line here going way up, but they would be followed by massive drawdowns, as you can see with the red drawdowns here. But after the creation of the ETFs, Bitcoin's price has moved far more consistently. It's still volatile relative to traditional assets like stocks and bonds, but it has not had a drawdown of more than 30% since the creation of the ETFs. So while Bitcoin hasn't had one of these massive booms where it goes up 1,000% in a 12-month span, it has been able to produce consistently positive year-over-year returns, varying from 50 to 100%, all while having none of the drawdowns that Bitcoiners have become accustomed to. The next chart here is called NUPL, which stands for Net Unrealized Profit Loss. The NUPL has oscillated between 45 and 65% post ETF, indicating that dips in the Bitcoin price are quickly bought and pumps are quickly sold. Prior to the ETFs, the NUPL had a much wider range of oscillation. A similar pattern of behavior can be observed when looking at on-chain realized profit and loss. This metric is calculated by measuring the difference in the Bitcoin price from the time a coin is acquired to the time it is moved on-chain. When we adjust for market cap, we can see that realized profits have been consistently lower post-ETF, but they are also consistently positive, unlike the pre-ETF era in which coins frequently moved at a lower price than what they were acquired at. The second section of this report is very, very important, so pay close attention. In this section, we are looking at Bitcoin's realized cap and how this impacts the Bitcoin price. Realized cap, shown on this chart in orange, is a measure of Bitcoin's capital inflows on-chain. This is calculated by adding up the dollar value of every Bitcoin based on the price at which each of those coins last moved. One of the best ways to measure the maturity of Bitcoin's market is the diminishing multiple between the realized cap and the market cap. As we can see in the MVRV multiple, the green line here, the euphoric peaks are a thing of the past. Prior to the ETF, Bitcoin would have these boom cycles, and the market cap would regularly reach peaks of a 4 to 8x multiple above the realized cap. After the ETF, the MVRV multiple has consistently oscillated between 1.7x and 2.7x. So the market is pricing in a multiple on the inflows into Bitcoin, but it's not the same drastic multiple that we saw before the ETF. Now, let's go a little bit deeper. Let's run a logarithmic regression showing us how realized cap statistically impacts market cap. The R squared value of this regression is 0.98, which tells us one thing. Bitcoin's realized cap has a significant impact on Bitcoin's market cap. Now, that's unsurprising, but what's very interesting is how this regression has evolved over time. This chart here shows us the rolling residual volatility. Now, in statistics, a residual is the difference between an actual value and a predicted value. Since we're using realized cap to try and predict the market cap, lower residuals means that our prediction is more accurate. The green line shows us the residual volatility before the ETF, and the orange line shows us the residual volatility after the ETF. Because this line is much lower after the ETF, that tells us that realized cap, which is a measure of capital inflows, are much more predictive of what Bitcoin's market cap and ultimately price will be. Inflows now have a far more steady and predictable impact on the Bitcoin price. This box and whiskers plot here shows us the spread of the residuals. If you'll notice the green box, which signals pre-ETF, the residuals have a much wider range and longer whiskers, showing larger deviations from the regression line. This indicates an immature retail-driven market with significant over and undershooting relative to realized cap. Now, the orange box post ETF, the residual spread is noticeably tighter with fewer and smaller outliers. This confirms our thesis that post ETF, the relationship between the realized cap and market cap has become more steady and more predictable. Lastly, we have this bar chart here, which shows us the same thing. Bitcoin's market now behaves with significantly reduced dispersion, aligning much more closely with the underlying capital inflows. Now let's move on to section 3 of the report, which takes a deeper look at Bitcoin's halvings. The fundamental belief surrounding Bitcoin's 4-year cycles is that parabolic booms and the subsequent busts are catalyzed by the halvings which occur every 4 years. But this chart here shows us the diminishing marginal impact of a decrease in new supply relative to the amount of Bitcoin already in circulation. This poses a problem for those who anticipate the continuation of the 4-year cycle. As you can see here, the 2024 halving had a much smaller impact on Bitcoin's supply than, say, the 2012 or 2016. In fact, when we look at this chart here, we can see that during the ETF era, long-term holders have provided more supply to the market than Bitcoin miners. As such, the primary method through which new demand is able to acquire Bitcoin is not from miners, but it's from bidding the price higher until existing Bitcoin holders distribute their coins into the market. Prior to the ETF, long-term holders very rarely sold their Bitcoin, and they would only do so after the Bitcoin price increased by an order of magnitude or more. However, post-ETF, Bitcoin holders are far more responsive to changes in the Bitcoin price. 3 times they've become net distributors following just a 50% increase in the Bitcoin price. The institutional participants of the ETF era are quick to rebalance after a 25 to 50% return on their Bitcoin holdings. Now, a 25 to 50% return is low by historical Bitcoin standards, but you have to remember, the new market participants brought in from the ETF come from traditional finance. And by traditional finance standards, a 50% return is fantastic, especially given the current risk-free rate of the US 10-year Treasury is around just 4%. The fourth section of this report may surprise you, and in this section, we take a look at other digital monopolies. Bitcoin is a unique asset class. There is no one-to-one or apples-to-apples comparison, but the best thing we can do is take a look at how the market has priced other digital monopolies, such as Apple and Amazon. And Bitcoin has followed a pattern very similar to these other world-changing digital technologies. Extreme volatility early on as the market tries to make sense of the technology and the scope of its potential impact. However, the magnitude of drawdowns and volatility diminishes over time. We can see that here in this chart, which shows the annual maximum percent drawdown in various tech assets since their IPO, or in Bitcoin's case, since its Genesis block. We can see that for other digital monopolies, they had these massive drawdowns early on, but they diminished over time as the asset matured, and Bitcoin is following a similar pattern. And the chart here shows us the annualized realized volatility for all of these different tech assets. And the black line here is the average of them all. Again, high volatility early on, but that volatility declined with time. Bitcoin is no different. Now, I will pause here and reiterate. Our thesis is that Bitcoin's 4-year cycles are over, not that Bitcoin's volatility is going away. Bitcoin is still very much volatile relative to stocks, bonds, and other traditional financial assets. All right, so this brings us to the fifth and final section of the report, which analyzes the future potential Bitcoin price based on capital inflows, which, as we've discussed in this video, are now the primary driving force. This chart here is three-dimensional, so you got to pay very close attention. On this axis here, we have the realized cap. So again, this is Bitcoin's on-chain capital inflows. And on this axis here, we have the MVRV multiple, which is the multiple that the market prescribes to the net inflows. And then on the z-axis, which goes up here, we have the Bitcoin price. So based on the respective realized cap and MVRV multiple, we can calculate what the Bitcoin price would be. Now, I recommend pausing and taking a good look at this chart and coming up with your own idea. How much capital do you think Bitcoin will absorb in the coming years? What multiple do you think the market will put on that? And then from there, you can figure out what you think the Bitcoin price will be. Now, in this chart, we've projected out realized cap over the next 4 years. But what I've done is I've taken the rate of capital inflows from the past year and extrapolated it into the future. So over the past 12 months, Bitcoin's realized cap has grown by $420 billion. That's over $400 billion worth of inflows into Bitcoin. If inflows continue to compound at this rate over the next 4 years, realized cap would reach roughly $2.7 trillion. Based on a conservative MVRV multiple, this could yield a Bitcoin price of anywhere from $230,000 to $320,000. Again, we'll come back to this chart because Bitcoin could get a lot more than $2.7 trillion worth of inflows. We have ETFs, but we also have significant momentum from Bitcoin treasury companies, which provide vehicles for all sorts of different capital markets, not just the United States. The total addressable market for Bitcoin is every asset the world is currently using to store value. In this chart here, we can see how much room Bitcoin still has to grow. Gold, which is the physical analog inferior version of Bitcoin, has a market cap north of $20 trillion. If Bitcoin simply reaches parity with gold, we could easily be seeing $1 million per Bitcoin or higher. Now, if you want to acquire Bitcoin, the best way to do that is by mining Bitcoin with Blockware. Bitcoin mining allows you to acquire Bitcoin every single day at a discount to the market price. Blockware clients using S21XPs, which are the latest and greatest Bitcoin miners on the market right now, are acquiring Bitcoin every single day at $50,000 per coin. Moreover, Bitcoin miners get significant tax advantages. In the United States, we now have 100% bonus depreciation. This means you can depreciate 100% of the cost of a Bitcoin miner in a single year. So to put it simply, if you purchase $100,000 worth of Bitcoin miners, you can write off $100,000 worth of ordinary income. So whether you're a W-2 earner or a business owner, you could benefit from Bitcoin mining by legally lowering your tax bill and also acquiring Bitcoin at a discount. You can get started today by going to mining.blockwaresolutions.com/consult. Schedule a free 30-minute consultation with a member of our team, and we will create a customized plan to fit your needs. Again, that's mining.blockwaresolutions.com/consult.